This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello and welcome to this week's episode of the AJ Bell Money and Markets podcast. I'm Charlene Young and joining me today is Laith Khalaf.
Yeah, hi Charlene. We've got quite a lot to get through today. We're going to be talking about the latest inflation reading and the latest employment figures in the UK. We're also going to be celebrating 0.1% growth in the economy in the final quarter of last year. So hang on to your party hat for that, Charlene. And we're also going to be asking if Elon Musk's proximity to Donald Trump might just be beginning to damage his business interests. And we'll be finding out as well what the activist investor Saba Capital is up to now.
Yes, on a similar note, Dan Coatsworth caught up with the fund manager Charlotte Cuthbertson from the Migo Opportunities Trust about her strategy of building stakes in discounted investment trusts and how she takes a completely different approach from that employed by Saba. We'll also be checking out some recent developments in the cash market, including some unusual rate changes from NS&I and why there's a record amount of money sitting in bank accounts paying no interest. But firstly, let's talk banks. We've had some results out this week from the big UK players, haven't we?
Yeah, that's right. Three of the big four banks in the UK have reported. We're recording this on Wednesday afternoon. Lloyds is yet to report, but we've had today HSBC just reporting. Of course, it's kind of one of the biggest banks in the UK, but just bear in mind that most of its earnings actually come from the Far East. It's had a reasonable year. If you strip out currency and exceptional items, profit was up 4% in 2024. It's paid a dividend of 87 cents per share, which includes a 21 cents special dividend. Plus, it's announced a share buyback of up to $2 billion. Probably the big news was actually the cost-cutting measures that HSBC has confirmed. They're going to look to take $1.5 billion out of its annual cost base by the end of 2026. So longer term, that should be good for profits. But in the shorter term, that's going to cost $1.8 billion to achieve. Some of that in severance pay. And what that means, of course, is job losses. Another interesting sort of release that we saw alongside the results was that HSBC has pushed back its goal to meet its net zero targets for operations and supply chain. So it was aiming to get to net zero by 2030. It's now saying it's going to get there to by 2050, citing factors outside its control. And, this is kind of an ongoing trend that we're seeing at the moment. We've seen a raft of big US banks walk away from the net zero banking alliance. So the likes of Goldman Sachs, JP Morgan, and Morgan Stanley. HSBC remains a member of that net zero banking alliance for now, but we are kind of seeing companies creeping back on their climate promises, and you can probably imagine why that is, I suspect. If we look at outside of HSBC, Barclays and NatWest, which have more UK operations, their full year results were pretty decent as well. Barclays profits were up 24% on last year to 8.1 billion pounds, that is. Barclays reporting in pounds, HSBC in dollars. Barclays also returned £3 billion to shareholders in 2024. That was a combination of dividends and share buybacks. And it intends to return a further £7 billion in the next 2 years. Its investment banking operations had a pretty strong final quarter around the US election. Lots of people trading in both equities and bonds with all the volatility around that. And, it's a fairly similar-ish, if not better picture at NatWest, which of course used to be Royal Bank of Scotland. Full-year profits and dividends came in, they beat analyst expectations. So again, we've seen large amounts of money returned to shareholders in the form of dividends and share buybacks. Alongside dividends, the bank returned £4.4 billion to shareholders in 2024, which is around 12% of its £35 billion market cap. So, the banking sector is doing reasonably well, returning money to shareholders. But despite that, for Barclays and NatWest, we saw quite negative share price reaction to the results. Both of those companies, we saw the share price on the day results were published falling by around 5 or 6%. And it may be it's kind of one of those things where analysts were perhaps a bit disappointed that the banks didn't upgrade their profit outlooks for the coming year. There's also maybe it's one of those kind of dynamics when it's better to travel than to arrive. Actually, banking shares have done really well over the last year or so. So if you look over the last year, Barclays shares are up 107%. NatWest is up 98%. So, the darling of the AI world, NVIDIA, is only up 102%. So these are pretty big numbers for the UK banking sector. And interestingly, NatWest is now almost approaching the £5 level, which is roughly what the taxpayer paid for it during the bailout, just after the financial crisis. So, taxpayers still nursing a massive loss because, we've sold loads of shares in RBS at much lower prices than that. And the current shareholding the government has is currently under 10% of NatWest, whereas at its peak, it actually owned 84% of that of the bank. And, that the fact that there's no longer this sort of big structural seller in play, that the overhang that the government might just come into market and sell off loads of shares, is probably one of the reasons that we have had good share price performance from NatWest in particular.
Thanks, Laith. And kind of in terms of the broader economy, I'm not sure what parties you like to go to. I would probably call it moderately good news. Growth of 0.1% in the final quarter of 2024. So no kind of technical recession in the making, that term we hear banded around a bit.
Yeah, bit of an odd one, this, isn't it? So 0.1% growth, as you say, in that final three quarters. Generated headlines, right? Like UK economy grows by 0.1% in unexpected boost for Rachel Reeves. Yeah. And
always says Rachel Reeves as well, not the Chancellor. Just
not the Chancellor, yeah.
Perhaps
Rachel
regretted
Reeves.
Tooth, I don't know.
And we've also seen kind of like headlines like economy showing surprise growth at the end of 2024. So I guess this is kind of against the background of 0% growth in the third quarter of 2024, and expectations that actually in that final quarter we were going to get a 0.1% decline. So as you say, Charlene, that could have been seen as the beginning of a recession, which technically here at least is two quarters of negative growth. So I guess there's a little bit of a positive there, but that's still very weak growth. If you're looking at getting growth of 0.1% versus getting growth of minus 0.1%, there's not a huge amount of difference between these two outcomes, right? And GDP per head actually fell by 0.1% over the course of the year, which means living standards are stagnating, going slightly down. So all of this kind of builds up problems, I think, for Rachel Reeves. If you look at what the Office for Budget Responsibility forecasts were back in, it was October, the budget, wasn't it? End of October. The OBR reckoned 2024 we were going to get 1.1% growth. We got 0.9%. So we're beyond where the forecasts were, and that obviously feeds into the fiscal picture in terms of what Rachel Reeves is performing against her own fiscal targets. This is all before we've got concerns about the economy because of, the higher national insurance coming in from April. And, at the moment, the Prime Minister is talking about defence spending. Is that going to be something that Rachel Reeves has to factor in as well? So again, it's increasingly looking like in the spring statement, something's going to have to give in terms of what she does. That's more taxes, less spending on unprotected departments, or changing the fiscal rules. So, not a great economic picture, despite the celebrations, Charlene. But I mean, one area where we're looking fairly robust, I think, is the jobs market. You've got the latest figures there, I think.
Yeah, I'd say robust kind of on the face of it. So if we're looking at those figures, wage growth was up from 5.6% to 5.9%. And vacancy numbers fall again for the 31st consecutive period. So looking at unemployment as well, holding steady at 4.4%. But I guess, is this the calm before the storm? As you mentioned, we all know what's coming in April. We've got that hike in employer national insurance and increases in the national living wage. Is the market kind of tough enough to ride it out? And that's really the question here. So on the kind of positive side, for being optimistic, if you're digging into that vacancies data, Vacancies still higher than they were 5 years ago. So just before the first lockdown, we're coming up to that anniversary. But they have been steadily falling back. Demand has been coming largely from the construction areas. And wage increases show a commitment, don't they, to, employers wanting to keep hold of those reliable skilled workers, particularly because they don't then have to go through recruitment and retraining further down the line. But on the other side, it's really hard to kind of ignore reported data and just the sentiment that's out there. So last month on the pod, we discussed updates from Page Group, amongst others, but numbers out from the Chartered Institute of Personnel and Development are sort of sobering reading. So, a third of the companies they surveyed said that they plan to reduce headcount. 4 in 10 said they plan to increase prices. So, future price rises on the horizon, plus robust wage growth feeds through to interest rate expectations, of course, and something that the Bank of England will already be looking at closely. Now, as you mentioned, we are recording this Wednesday afternoon, and we've just also this morning had the latest inflation data for January. Laith, what's behind these figures, and does it pour any cold water on some of those predictions for a series of cuts throughout this year?
Yeah, possibly it does. I mean, we've had CPI in January jumping up to 3%. It was up from 2.5% in December. So, on the face of it, that sounds like an inflation shock. I'm not sure it's a big inflation shock that it might seem at first glance. That's because if you look at prices, between December and January, prices actually fell back by 0.1%. But inflation is an annual number. So what happened is that actually prices last January fell more than they did this January. So they fell 0.6% last January. And, we've got some volatile items kicking around and creating some uncertainty, I think, in the kind of December to January readings. So we've got stuff like airlines and VAT on private school fees, which might feed out of the equation later on. If you look at where kind of core CPI is, that strips out kind of volatile elements like food, energy, alcohol and tobacco, basically all the fun stuff. Then that came in at 3.7%, which was on where economists expected it to be. And services inflation is actually a bit lower than the 5.1% expected. So, you could probably tell from all of that, those numbers are relatively stable-ish, but still higher than where the Bank of England wants to be at 2%. And what's probably more important is not what's in the rearview mirror, but actually what's in front of us. So the Bank of England itself reckons that inflation is going to head up to 3.7% later this year. That's before any kind of skullduggery comes in with tariffs and such. And we've got forecasts from Cornwall Insight, the energy specialist, suggesting that typical energy bills are going to rise by £85 a year from April as well. And as you say, Charlene, that NI and national living wage, that survey that you mentioned, I think was pretty significant. 42% of affected employers, right, saying that they're going to raise prices as a result of that. That's quite a lot of inflationary pressure. And that does, of course, mean that the Bank of England is likelier to keep rates higher for longer. But strangely, the market is actually still pricing in 2 rate cuts in the next 6 months or so. Right. And you can kind of see why, I think, right? You've got, the Bank of England doesn't think the economy is going to do that well. This living wage and national insurance hikes, yes, they might be price increases, but they also put pressure on jobs. And if you look at the latest the voting record from the Bank of England, 2 policymakers in the last vote actually wanted to cut rates to 4.25%. But equally, right, wage growth is 5.9%, looks like it's rising. If you've got a strong dollar and trade tariffs, that might put inflation up. And the thing for me, Charlene, is that if we're going to get inflation rising this year, if the Bank of England is cutting rates, that's a really difficult message to deliver to people, isn't it? Particularly for central bank, which has been hauled over the coals for telling us that inflation was temporary just before it rose to double digits.
Yeah, absolutely. It was 11.3% at one point. It's just
that's right. Yeah. So the Bank of England does look at the longer term in terms of its inflation forecast. So it's not going to be just looking at the next couple of months. But I just think that if inflation is heading up to 4%, and then quite a few economists are saying they think it's going to get to 4%, the Bank of England is cutting interest rates at that time. I think it's very difficult, kind of psychologically, for those policymakers to say, yeah, we're going to take our kind of foot off the throat of inflation at the point at which it seems to be taking off.
I think especially when that's your one main target, and you're sort of looking forward to the future, saying we think it's going to be 3.7%. That's nearly double the target. And like you say, they do look long term, but it's just seems like there's that desperation to stave off that stagflation as well.
Yeah, and I just think that there's a risk, right? That the market's saying we're going to get 2 interest rates. There's just a risk that might not come to pass. So you shouldn't bank on it. But we've also, I think, we've seen a bit of jostling for position in the cash market, haven't we? Some news from NS&I on the cards as well.
We have, yeah. We've had some a hike, I should say, to the rates from NS&I. So this is for its direct ISA. So the rate is going to be hiked from 3% to 3.5%. And, that's kind of indicative of the fact competition in the ISA market is pretty hot in the run up to tax year end. Now, a word on this rate. Yes, it is a big hike, but it's still significantly below kind of the top rates in the cash ISA market, which at the moment we're hovering around about 5%. According to the data out there. Now, I will say some providers paying that highest variable rate are sending out emails as we speak, interest rate updates after the cut, obviously in the base rate last week, but still significantly higher than what NS&I are paying. But, we know with National Savings, people are willing to give up that interest because they really value and are hugely loyal to the brand and the safety that comes with being kind of fully government backed. So that kind of loyalty to NS&I really shines through when you consider premium bonds as well. So different direction here. NS&I has cut the expected prize fund rate on premium bonds again. So although the odds of winning remain the same, the number of prizes at certain levels has been cut. So the total monthly prize fund has come down from 430 million down to just over 411 million pounds. Now, quick word on premium bonds. I think we know the average return is far lower than people could get with an easy access savings account.
Nice and tax-free, those premium bonds winning.
Well, yeah, our own research showed that 2/3 of holders have never won a single prize, but
right.
14.4 million people. But people love that lure, of that tax-free prize. So I think most people know they probably aren't getting the best deal, and for some people, premium bonds do work out pretty well, but on average, comparing to those easy access cash accounts, it might not work out the best deal in the long run. And I think just kind of a word on cash ISA season, if you like, which we'll talk about a bit more later, I think. But it's good to kind of see that choice and competition out there for people on the lookout for good rates. And again, we'll talk about choice in the market in a sec, but this assumes people are shopping around in the first place. And, we've got some absolutely staggering figures from the Bank of England on how much cash is sitting in accounts paying absolutely no interest.
Yeah, that's right. A bit of an odd one, this, I think. Bank of England data, which shows that a record amount of money is held in accounts paying no interest. So it was a record high of £282 billion in November, according to Bank of England data. So if you think about what that means, this is like over £250 billion that's not earning any interest, yeah? So if you say that money was getting 5% interest, which is your top rate, that's going to give you £14 billion in interest, which if you just divide that out between 28 million households, that's about £500 a year.
Wow.
So what's odd about this, Charlene, is that we've got this record amount of money in accounts paying no interest now, because interest rates are, base rate is at 4.5%, whereas for years it was at 0.5%. Mm-hmm. So there's been this kind of £44 billion reclassification from the Bank of England, which has really bumped it up to a record level. But even before that, it was £230 billion, which is still a lot of money. And
it's crazy numbers.
It's a huge amount, isn't it? I mean, when you compare this to, like, if you look back to 2008, before the emergency rate cut, the number was below £50 billion. So obviously what's happened is that rates are cut to 0.5%, yeah? And at that point, you see this huge increase over the course of the 2010s in the amount of money that's not paying any interest. then interest rates start going up, that money doesn't fall. So why is that? It's a bit of a puzzling one. So one answer is that banks are taking the mickey. It's, one of those, kind of dynamics where, things kind of go up like a rocket and then fall like a feather. That's part of it.
Yeah, it's all the regulator taking a bit of action in that area over recent years, haven't we? But
they have, absolutely, yeah. So making sure the banks are providing, fair outcomes for their consumers and passing on interest rate rises. So maybe there's a little bit of that and people not moving out of older accounts. I don't know. Maybe it's current accounts, but even my fairly rubbish current account with an unnamed bank is paying interest nowadays. So one of the other things it might be, there's a lot of the kind of figures include money in transit from one place to another. And maybe now that we've got a digital economy, it's a more digital economy. It's the case that, there's more money in transit. That's possibly an explanation. But it is puzzling that there's all this money, but it is there and people do hold it. And so there is obviously kind of a huge reward for moving that to a more competitive rate. Yeah, maybe in time we will see it fall back again. But let's move on to another part of the cash world, Charlene. Let's talk cash ISAs. So rumors flying around.
Yeah, absolutely. So we've seen the CBI, amongst others, banging on the door of Rachel Reeves, suggesting that the tax benefits of the cash ISA that we just talked about should actually be withdrawn. And perhaps that's a way of, unlocking. There's some dubious numbers being bandied around on this, I will say, X billion amounts of investment in the UK. Obviously we have that target of growth. And, is getting rid of the cash ISA really the answer to this? I'm not so sure.
Yeah, I mean, the city's obviously kind of pushing for it, aren't they? I think I can kind of see some of the arguments for it, not the ones that they're making particularly, but I can kind of see why we've got this £20,000 ISA allowance, which, the question would be kind of why are we providing, taxpayer subsidy to people to hold cash, which isn't particularly economically useful. And also, if you think about what we tell people in terms of how much cash you should be holding, your typical financial planner says 3 to 6 months of expenditure. So why are we allowing people to build up like hundreds of thousands of pounds in cash ISAs just to hold cash when we don't think that's a good thing for them to do? We don't think it's a good thing for the economy to do, and the taxpayer is subsidizing it. So I can kind of see that point of view. I think the issue is that, it's cash ISAs and stocks and shares ISAs are now kind of joined at the hip in terms of you can transfer in and out of one. So if you start messing around with the allowances, then there are problems in terms of portability between the two.
So one of those ideas is, rather than restrict cash as an allowable asset in an ISA, to perhaps go back to the old days and have a different allowance for cash ISAs versus stocks and shares ones. But like you say, perhaps there's not been a lot of joined up thinking on exactly how you're going to monitor that and stop people transferring between the two. People have to hold an element of cash in certain investment ISAs for fees, or they'll be receiving dividends, or there's quite a lot to kind of think about. And aside from those transfer issues, it just creates more complexity in something that, our view is should be simplified even further.
It creates more complexity, and also it kind of undermines confidence as well, I think. And I also just don't buy this fact that, the city thinks it's going to unlock all this money to go into shares. I'm not sure people are kind of holding cash because of cash ISAs. I think people hold cash because they're familiar with it. And, people kind of who are financial planners, people in the investment industry, people like ourselves, need to make an argument to people to say this is why you should move out of cash, rather than taking away the tax benefits. I think probably is kind of how it kind of breaks down to me. But like I say, you can see why the Chancellor might be tempted by this, right? Because she's in a difficult fiscal situation. I don't think it's going to happen because cash ISAs are pretty popular. But who knows? I think Charlene's probably one that would come out at the budget, right, rather than the spring statement. I mean, who knows? But if it was to be like, it would be quite a big
Yeah,
big
absolutely.
change
We've
to
seen
make.
some, campaigns suggesting buy now while stocks last because of the spring statement. But for we know at the moment, it has been confirmed that spring statement at the end of March will be more of an update and a forecast rather than, to use the official term, a fiscal event with big tax changes, which is, the plan was to reserve that for the autumn. But yeah, I kind of watch this space, I think.
Definitely, yeah. Well, let's have a look at another part of the market, shall we? Let's look at investment trusts. So Saba, have you been following what's going on with Saba? Charlene, this kind of investment trust.
all of these votes, yeah.
Battle. Yeah, so basically Saba is, just to give you kind of everyone the story so far, they're an activist investor. They tried to take control of 7 investment trusts that were trading at discounts. By getting the shareholders to vote on chucking the directors out and appointing Saba and Saba elected representatives to the board. They've been roundly rejected on the 7 trusts where the votes were held, but Saba's not going away. They've got a new tack. They're targeting 4 trusts now, so it's gone from 7 to 4. They're still on the register of the other 7, so they're not going away anytime soon. So 2 of the existing targets are already included in the 7, actually. So CQS Natural Resources and European smaller companies. And then they're also targeting 2 new ones, Middlefield Canadian Income and Schroeder UK Midcap. Again, they're kind of looking at, companies that are on a discount. So they're expanding their reach, really showing that they're here for a long time, not a good time, I think. These trusts were trading at a discount. Now, Saba's taking a little bit of a different tack this time. So with one of the trusts, European Smaller Companies Trust, which was one of its previous targets, it's now entered into negotiations. So there's a 30-day period where we don't know what's happening, but Saba's basically talking to the board and trying to find a way forward together. With the other 3, what it's saying is we'd like shareholder meetings and we're going to ask shareholders to vote on converting these trusts to open-ended funds. Okay, so not changing the board. This is probably, it seems on the face of it, an idea that might get more traction because you can continue in the same investment strategy. Or, if you convert to an open-ended fund, that should mean that you get to the net asset value of the trust. So the discount is closed and you make money that way. So potentially it might get more traction. We'll have to see how shareholders react to it. So yeah, just an interesting new tack from Saba. Like I say, the 7 votes that we've had so far, they were roundly rejected, but clearly they've still got big stakes in these companies. So
no,
they're not
and I
going
think
anywhere
we
soon.
saw in our own data, shareholders were highly engaged in these votes as well. Looking at the amount of shareholders that voted on these proposals or rejected these proposals, versus other kind of actions. So I'm all for kind of more investor engagement and things, but yeah, it sounds like they're not going away anytime soon. And Saba might be the ones making all those headlines as we've talked about, and we're talking about them a lot, but its strategy of kind of buying up deeply discounted trusts isn't a new thing. In fact, it is the same strategy adopted by Migo Opportunities. Yet the way I guess Saba has gone about calling for those changes is different to Migo's approach, as we're about to find out. So we sent Dan Coatsworth, our roving reporter, out to speak to Charlotte Cuthbertson, Migo's co-manager, to explore the differences in approach. So please can we hear that interview now?
Well, Charlotte, thanks ever so much for joining us. I guess anyone who's sort of been following the investment trust space will be aware that we've had an activist investor called Saba. They've been targeting discounted investment trusts, trying to drive change, narrow that discount to net asset value. How does that approach differ to what Migo does as an investment strategy?
No, thank you for having me. So Saba, the way that they've done activism is quite different to how we run Migo. So Migo kind of look for the overlooked, unloved discount opportunities. We do engagement, in order to try and narrow discounts and to enact change. But a lot of it tends to be more behind closed doors. We try to look a bit at self-help for trusts. It tends to be quite collaborative. So that's kind of what we look at and how we think is the best way to go about it for us, obviously.
From a perspective of a fund manager or an active investor, obviously you think, okay, well, here we are, an investment trust, it's trading on discount to net asset value. Is narrowing that discount harder than it looks? You know, I know that Migo's share price is relatively flat over the past 3 years.
Yeah, so it's been an incredibly difficult period for investment trusts. If you look at the average discount over the last 2.5, 3 years, we've gone from trusts as a whole trading at sort of NAV level to incredibly wide discounts, across the sector. And that's been a few reasons. First of all, rising bond yields has sort of undermined lots of the alternative asset trusts. Investors have moved back to more traditional sources of income, and so have moved away from trusts like infrastructure, property, renewables, those areas that were producing income. So we've seen massive discount increases in those kind of areas. We've had problems with the ongoing charges where trusts have had to put up much higher charges. And that's also put off investors from investing in a sector. We've had some quite high profile blow-ups from some of the trusts. Again, that's put people off investing in the sector. So yes, this has been a really, really tough period for narrowing discounts. We are optimistic about, looking forward, instead of necessarily, what we would see, in past years where overlooked and unloved trusts would come back into fashion. What we think actually will be the catalyst going forward is more corporate activity. So it's not necessarily that some of these trusts are doing anything wrong. They have good underlying assets, but it's actually investors trusts that are in the sort of the bear market. They're in the doghouse, and it's an area that people are reticent to invest in at the moment. But lots of these trusts have good underlying assets. And so what we think is more likely is that we'll see an increasing amount of takeouts, of realizations. And we think that, with what's been going on in the sector, we'll see more trusts doing things like buyback, tender offers, etc. And that should help narrow discounts. But no, it's been an incredibly tough period for the last couple of years.
I mean, the Saba's campaign does feel like it's a bit of a wake-up call for the industry to be more proactive in doing something to narrow these discounts. Obviously, you mentioned about you think there'll be more buybacks and stuff like that. I had a quick look to compare what some of the sort of a variety of sectors were trading at in terms of versus their 12-month average discount. It does feel like the discounts are sort of slightly narrowed, certainly over the last month. But do you think that, if we don't get another wave of consolidation, mergers and stuff, and if we don't get a big increase in sort of share buybacks, is there still anything left for this sector to do, or do you think that if someone is not doing something now, given the sort of all the spotlight's been shone on the industry, that nothing's going to happen at all?
I think there has been complacency in the investment trust market from both boards and managers. There's been a lot of hoping for better days. There's probably been a considerable amount of hoping that the market turns, hoping that bond yields come down, etc. Well, I think that period is now over. I think, activism and Saba's activism has shone a light on how wide discounts are. And I think, regardless of what people think of Saba's actions, it's been very important to hold boards' feet to the fire and say, you have to be doing something. It's not, it's no longer reasonable to allow a trust to languish on such wide discounts. And so I think that's been very useful. And, it's not just Saba. I think actually across the piece, in terms of investors of trusts, they're saying, now is the time to be doing something, and we're not going to, rest on our laurels, and we're gonna hold you to account.
Obviously, you're looking for opportunities now for, particularly for stuff that's cheap, and you're hoping for discounts to narrow. And it seems like perhaps there's a bit of a tailwind in your favour. I mean, are you still finding that there's plenty of good opportunities now, or do you think actually there's a downside to this in that Saba is sort of shone the spotlight, and some of those bargains are no longer as real bargains as perhaps you could have found 6 months ago.
Yeah, I mean, I think Saba's been particularly focused on the equity side of the sector, and I actually think that there's lots of opportunities outside equity trusts. There was a huge amount of issuance into alternative asset classes over the past sort of 10 years. And we do have, oversupply in the market, and that's why discounts are so wide. But there are opportunities there for things to change, whether it's selling off some assets and handing cash back to shareholders, which should help narrow discounts, whether it's realizations. We've seen in the property sector some takeouts by private equity and private capital. And these things are all very, very helpful for the trust industry going forward. I mean, discounts are still very wide. So we certainly don't think that we're anywhere close to the end of this part of the cycle. We think the cleanup will continue, and we're very hopeful that it should be a profitable period for us and for other people investing in trusts.
Yeah, I mean, perhaps could you give me a couple of examples of where you and Migo have engaged with another trust and perhaps driven or benefited from change that's happened?
Yeah, so a good example of sort of a recent trust would be PRS REIT. We were involved. It was, a combination of a few shareholders requisitioning the board there. We placed two new shareholders on the board. We asked them to put through a strategic review. And that portfolio is now going through a sales process, and the share price has reacted accordingly. Now that investors can see that there's a catalyst for narrowing of that discount, and it's narrowed considerably since when we first made our investment. So that's probably a good example of something more recent. Obviously, I'm not going to touch on anything that we're doing currently, but yeah, I think that's probably a good example.
I mean, our investment trusts, if you're on a board of an investment trust and you've got, a group of shareholders come knocking on your door demanding change and board seats, do they have to accept everything that you're asking for, or do you find actually that you get a lot of pushback from trusts?
I think it's very important for boards to remember who they're working for, and it is the shareholders. It should be one of the big benefits of investment trusts is there's a board there, and they are there to work for shareholders and to listen to them. You might not agree with everything that a shareholder comes to you and says, but I think that there has to be a constructive dialogue. I would say that we speak to quite a lot of directors and chairmen, and it can be that you get a bit of pushback. It can be that they're very open to these conversations. It's quite dependent on the board. But I think in this climate, I think boards have accepted that it is, it's very important to listen to shareholders and understand, their concerns and their thoughts about where the trust should go going forwards.
And I presume if you've got an activist investor publishing a letter publicly, or a fund manager like yourself making comments about what you think a trust should do, perhaps in your results, is that sort of a recognition that you perhaps have had conversations behind closed doors and that you weren't listening to you? Because I got the impression that if someone goes public in terms of demands for change, it's their avenue of last resort because they haven't got anywhere so far.
Yeah, I mean, I think it's, that I can't speak for, other activists and other shareholders. I think, for ourselves, we prefer to do things more behind closed doors. And for us, anything that once you're out in the public domain, things can get, a bit more heated perhaps, because, when something's public, it's there's reputations, etc. involved. So we think that it's personally and for us, we try and do things a lot more behind closed doors and privately. And it tends to be if someone's publishing something, then that's sort of got to the end of that process. But again, I can't speak to everybody. There are obviously people who prefer to go public much earlier on.
Yeah, well, brilliant. Well, Charlotte, thanks ever so much for coming on the podcast, talking about this subject. It's really fascinating to get your views on it.
Sure, no problem.
Okay, thanks to Dan and to Charlotte Cuthbertson from Migo for coming in and talking to us. Now, one final bit of news. Charlene, it's what seems to be becoming a regular feature on the pod, Musk Watch. What Elon Musk has been up to. Actually, it's not what Elon Musk has been up to. It's what other people have been doing in response to Elon Musk. There have been protests in the US at Tesla showrooms, which is kind of an interesting development, isn't it? And I think it raises an interesting question about whether Musk's political affiliations might actually be starting perhaps to harm his business interests.
I did see something on social media as well, a similar one by a well-known social media sort of activist group outside Tesla in Berlin as well.
Oh, right. Okay. Yeah, I didn't see that one. So it's happening in Europe as well, which kind of makes sense. Now, I think it's probably fair to say that Musk has done quite well financially out of the US election. Like the Tesla shares are up 60% since the election. So that's obviously a big boost to his wealth. But, on the ground, our car sales going to suffer. There's some interesting data out from the California New Car Dealers Association, which showed that for last year, Tesla actually saw almost a 12% drop in sales. Now, this is California. It's important because it accounts for around a third of the US electrical vehicle market, but it's obviously a notoriously blue state, right? A Democrat state. And, if you're also, this is a generalization, but, if you think about who is buying electric vehicles, it probably is, your kind of sandal wearing, tofu eating, liberal elite, right? I wasn't talking about you, Charlene. But those, I guess, there's an overlap between people who are Democrats and people who care about the environment, right? And that's probably a main reason why you are going to buy an electric vehicle. And it's not like buying a Volkswagen or a Nissan, is it? Because it's not like, I'm not going to buy Volkswagen because I don't like the CEO. Most people are like, I don't know who the CEO of Volkswagen is. Musk is just massively affiliated to Tesla. And if you think about it, most companies actually bend over backwards not to get involved in politics. And the reason that they do that is because they want to sell their stuff to everyone, and they don't want to kind of, alienate particular groups who might turn against them. And it's interesting what you said about Berlin, Charlene, because obviously he's getting quite vocal about European politics as well. And I guess there's a question about what happens there. And German data for January. So this is only 1 month. So I'm not saying this is a definite trend, but there was a 60% drop in Tesla sales against a backdrop of a 50% rise in the EV market compared to the previous January. So, a kind of optimistic kind of view from a Tesla point of view is maybe consumers are waiting for the upgraded Y model later this year, but that's quite a big drop, isn't it? And it would be unusual if politics didn't have something to do with that. So, maybe somewhere there will be a countervailing, bump in sales from MAGA supporters. You never know. It may be that they're not going to buy electric vehicles, Charlene. They may just be buying Tesla stock, right? Because it's still going up. So it's currently on 120 times forward earnings, right? So it's really, very expensive stock that is at the moment quite detached from the fundamentals. Now, there are probably reasons for that. People are expecting big growth from obviously kind of the electrical vehicle market, but also potentially autonomous cars as well. But, it's an important company. It's one of the Mag 7. It makes up, 2% of your typical US index tracker. So even if you're not gone and directly invested in Tesla, you might well have some exposure to it. So just an interesting one to keep an eye on, I think.
Definitely. Well, that's all for this week's episode of the AJ Bell Money and Markets podcast. Don't forget to subscribe wherever you get your podcasts from. And please leave us a review if you enjoyed the show. And as always, if you've got any questions or topics you'd like us to cover, please send us an email to podcast@ajbell.co.uk. Thanks for listening, and we'll catch you next time.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.